Picture this. You're staring at your screen, $100,000 in your account, and your heart's racing. Why? Because in the next few minutes, you could make a decision that will either set you up for a lifetime of passive income or potentially unlock generational wealth. But here's what keeps me up at night. I've watched countless investors make the wrong choice between SCHD and SCHG, leaving millions on the table. Let me share something that shocked me to my core. Last month, I met Mike, a former Silicon Valley engineer. He was exactly where you might be right now, torn between the siren call of SCHD's reliable 3.64% dividend yield and SCHG's mouthwatering 15.93% historical returns. But here's the kicker. Mike discovered something that changed everything. While others were debating dividends versus growth, he quietly implemented a strategy that had his financial advisor calling him in disbelief. What if I told you that choosing between SCHD and SCHG is like asking whether you want the engine or the wheels on your car? Sounds ridiculous, right? But that's exactly what most investors are doing. In the next few minutes, I'm going to reveal how a $100,000 investment could balloon into not just $8.58 million in growth, but also generate over $65,000 in annual dividends, without sacrificing either opportunity. You're about to discover why Wall Street hopes you never learn this, but first, let me show you the exact moment everything changed in the ETF investing world. It happened quietly, during the market chaos of late 2024, when a small group of investors noticed something unusual in the data. What you're looking at might seem like a normal market pattern, but hidden within these lines is a strategy so powerful, it could transform how you think about ETF investing forever. Ready to see what Mike discovered? Let's dive in. Now, before I reveal this game-changing strategy, let's understand what's really happening in today's market. Because trust me, it's not what most YouTube finance gurus are telling you. While everyone's been fixated on the latest AI boom sending the S&P 500 to record highs, something far more interesting has been developing under the surface. Here's what most investors are missing. The Federal Reserve's recent moves keeping rates between 4.25% and 4.50% have created a perfect storm of opportunity. Think about it. While tech giants like Microsoft, Nvidia, and Google have been stealing all the headlines with their record-breaking earnings, the real money-making opportunity has been quietly forming in the background. Let me break down what's actually happening. Right now, SCHD is trading around $27.79, managing over $68 billion and 2 cents in assets. That might sound impressive, but it's what's happening behind those numbers that's truly fascinating. You see, while everyone's been chasing the next big AI stock, SCHD has been quietly reinventing the dividend game. With its ultra-low expense ratio of 0.06%, it's not just preserving wealth, it's building it in ways most investors never notice. But here's where it gets really interesting. SCHG, currently priced at $28.94, has been doing something that defies conventional wisdom. While managing $37.14 billion in assets with an even lower expense ratio of 0.04%, it's not just riding the tech wave. It's fundamentally changing how growth investing works. Remember Mike, our Silicon Valley engineer? When he first looked at these numbers, he noticed something that most investors, even seasoned professionals, completely miss. It's not about choosing between SCHD's steady 3.64% yield and SCHG's explosive 15.93% annual returns. The real opportunity lies in understanding how these two ETFs interact with each other in ways that can multiply your returns. But before I show you exactly how Mike leveraged this knowledge to transform his portfolio, we need to understand a crucial piece of the puzzle that most investors overlook. It's about how these ETFs behave during different market cycles, and more importantly, how they complement each other in ways that could potentially supercharge your returns. You see, while SCHD holds defensive powerhouses like Coca-Cola, Pfizer, and Chevron, SCHG is backed by innovation leaders like Apple, Microsoft, and Nvidia. But here's the million-dollar question. What happens when you understand how to harness the power of both? The answer might surprise you, and it's exactly what we're going to dive into next. Before we dive deep into these life-changing ETFs, tap that subscribe button so you don't miss out on game-changing investment strategies that could transform your financial future. Schwab U.S. Dividend Equity ETF ticker symbol, SCHD. Let's talk about SCHD in a way you've probably never heard before. Right now, it's trading at $27.79 with a 52-week range of $25.18 to $29.62. But these numbers only tell part of the story. When Mike first discovered what was really happening with this ETF, he actually called me at midnight, unable to sleep because of what he'd found. Here's what makes SCHD truly remarkable. With $68.02 billion in assets under management, it's not just any dividend ETF, it's a wealth-building powerhouse. While most investors get excited about the 3.64% dividend yield, they're missing something far more valuable: the 11% average annual dividend growth rate. Think about that for a second. While others focus on the current yield, they're missing the compounding miracle happening right before their eyes. The beauty of SCHD lies in its carefully selected portfolio. We're talking about dividend aristocrats like Coca-Cola, KO, Pfizer, PFE, AbbVie, ABBV, and Chevron, CVX. These aren't just any companies. They're market leaders with decades of consistent dividend payments. And with an ultra-low expense ratio of 0.06%, more of your money stays invested, working harder for you every single day. Let me put this in perspective with real numbers that might shock you. That $100,000 investment we talked about? Through the power of SCHD's compound growth, it transforms into something truly remarkable. In just the first decade, your portfolio could swell to $231,442, generating $9,700 in annual dividends. That's already enough to cover a car payment and utilities. But the real magic happens as time passes. Fast forward to year 20, and your initial investment could balloon to $537,181, now producing a substantial $25,000 in yearly income, more than many Americans save in an entire year. But hold on, because the 30-year mark is where things get truly life-changing. Your portfolio could reach a staggering $1,247,892, kicking out $65,000 in annual dividends. That's more than the median U.S. household income. And remember, you haven't sold a single share. This isn't just investing. This is building a passive income empire that could fund your retirement dreams or create a legacy for generations to come. But here's what most investors miss. SCHD's stability isn't just about its high-yielding blue-chip stocks. The fund's relatively stable stock price fluctuations, combined with its strong dividend growth rate, create what I call the dividend velocity effect. While everyone's chasing the next hot stock, SCHD is quietly building generational wealth through a combination of steady price appreciation and growing dividend payments. However, before you rush to put all your money into SCHD, there's something crucial you need to understand about how this ETF performs in different market conditions. Because what Mike discovered next about combining SCHD with our next ETF, well, that's where things get really interesting. Schwab U.S. Large Cap Growth ETF ticker symbol, SCHG. Now, let me show you the other side of this investment equation. SCHG, the growth powerhouse that's been turning heads on Wall Street. Currently trading at $28.94, with a 52-week range of $21.68 to $29.14, SCHG has been quietly rewriting the rules of growth investing. And with $37.14 billion in assets under management, it's become a force that even the most skeptical investors can't ignore. What makes SCHG truly extraordinary isn't just its impressive 15.93% annual return, it's the companies driving this growth. We're talking about the titans of innovation: Apple, AAPL, Microsoft, MSFT, NVIDIA, NVDA, and Amazon, AMZN. These aren't just companies, they're the architects of our digital future. And here's the brilliant part. With an almost impossibly low expense ratio of 0.04%, nearly every penny of their growth goes straight into your pocket. Let me show you what this means in real dollars, and I promise these numbers might make you rethink everything you thought you knew about investing. Take that same $100,000 initial investment. In just 10 years, it could explode to $441,000, generating $1,700 in annual dividends. Yes, even this growth ETF pays you a modest 0.39% yield. By year 20, we're talking about a portfolio worth $1,945,000, with annual dividends reaching $7,600. But here's where it gets mind-blowing. After 30 years, your portfolio could reach an astronomical $8,580,000, providing $34,500 in annual dividend payments. But here's what fascinated Mike, and what most investors completely miss about SCHG. While everyone's focused on the explosive growth numbers, they're overlooking something crucial: the innovation compound effect. You see, these companies aren't just growing, they're reinvesting billions into emerging technologies like AI, quantum computing, and biotechnology. Every dollar they invest today could potentially create multiple dollars of value tomorrow. Think about it this way. When you invest in SCHG, you're not just buying today's tech leaders. You're buying tomorrow's breakthroughs. While NVIDIA is revolutionizing AI, Microsoft is transforming cloud computing, and Apple is reimagining consumer technology, you're positioned to benefit from all of it. It's like having a stake in the future itself. However, and this is crucial, what makes SCHG truly special isn't just its growth potential. It's how it behaves in relation to other ETFs, particularly SCHD. And this is where Mike's discovery becomes absolutely game-changing. Because when you understand how to properly combine these two ETFs, well, that's when the real magic happens. But before I reveal the strategy that could potentially outperform both ETFs individually, there's something critical you need to understand about market cycles and how they affect growth stocks. Because what I'm about to show you next could completely transform how you think about building wealth in the stock market. Now let me share something that changed Mike's entire investment strategy and could transform yours too. Instead of the endless debate between SCHD's reliable 3.64% yield and SCHG's explosive 15.93% growth, there's a smarter way forward. What if you could capture both? This isn't just about holding two ETFs. It's about understanding how they work together to potentially create something more powerful than either one alone. Picture this: your $100,000 investment strategically split across both funds, creating a dynamic portfolio that adapts to whatever the market throws at you. When tech is booming, you're capturing massive gains through SCHG's powerhouse holdings like Apple, Microsoft, and NVIDIA. When markets get shaky, SCHD's stable dividend payers like Coca-Cola, Pfizer, and Chevron provide both income and protection. The best part? With ultra-low expense ratios of 0.06% for SCHD and 0.04% for SCHG, nearly every penny of growth and income goes straight to your bottom line. Here's where it gets really interesting. Through strategic rebalancing and smart account placement, you're not just adding two strategies, you're multiplying their potential. Think about starting with $3,640 in annual dividends that could grow substantially over time, while simultaneously positioning yourself for the explosive growth potential of the tech sector. And unlike traditional balanced portfolios, this approach is dynamic, shifting with market conditions to help maximize your returns while managing risk. The implementation is surprisingly straightforward. Start by assessing your timeline and risk tolerance. Then, set up your initial allocation based on current market conditions. Remember, we're seeing record highs in the S&P 500 and incredible opportunities in both tech and dividend sectors. Schedule quarterly rebalancing to keep your strategy on track and place each ETF in the most tax-efficient account type. This isn't just about making money, it's about keeping more of what you make. Look, you could follow the crowd and choose between steady dividends or growth potential. Or you could take the path that smart money is quietly pursuing, combining both strategies for potentially better results. The choice is yours, but remember what Mike discovered. Sometimes the best investment strategy isn't about choosing between good options, it's about optimizing for great ones. If you found value in this ETF breakdown, smash that subscribe button and turn on notifications so you don't miss our next investing strategy video. Drop a comment below. Are you Team SCHD, Team SCHG, or are you going for the hybrid approach? Can't wait to hear your thoughts. This video is for educational and informational purposes only. Investing carries risk, and past performance doesn't guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions.